Hello from me, Kevin French. We will be giving you Core Wealth summary of the month of July 2025 and looking ahead at some of our thoughts for the future. July was a really good month for global markets, in particular the US tech market. The Nasdaq up quite strongly during the month, up 3.7%. The broader index, the S&P 500, was up 2.2% for the month. And this a lot on the back of good profit numbers coming out in a number of the larger companies on the back of improved profits from AI. We saw that knock on to global markets, and we've seen the global markets also had a good month, although not as strong as the US tech markets, but a good positive month globally. Further positivity coming into the markets just around future growth prospects. We saw the IMF raising their global growth forecasts for this year for the global economy on the back of improved situation in company profits. Did you know what happened on the 23rd of July this year? It was the first time the JSE All-Share Index went through the 100,000 mark ever. It pulled back slightly to the end of the month, but really driven by some of the resources stocks, in particular the platinum group metals and the gold shares, pushed the index through that level for the first time ever. Other news in South Africa was the highly anticipated cut in interest rates. We've seen inflation behaving itself and came out at 3%. On the back of that, the Reserve Bank cut interest rates by 0.25% in South Africa. So good for anybody who's got any form of debt, a mortgage or vehicle loans or company loans or overdrafts. In addition to the interest rate cut, the Reserve Bank also announced that it intends to target an inflation level of 3% instead of the previous range of 3 to 6%. The bond markets reacted positively to this, as did the currency initially. Subsequent to that, we saw the currency weaken a bit into month end as Donald Trump announced that he would be levying a 30% tariff on imports into the US from South Africa. We've seen that the rand strengthened somewhat after month end, however. So July was a good month for global markets, particularly the equity side, and we can see here developed markets up 1.3%, emerging markets up 1.9% in the month. But the more interest rate sensitive areas being listed, property and bonds, both negative for the month, although year to date still a positive return there. The other area that was really good, and this was what drove a lot of the emerging market returns in the month, was Chinese equities up almost 4% for the month as some of the trade negotiations started to settle a bit better. It's interesting if we have a look over the 3-year term and then over the 5-year number. Over the 5 years, the US still the place to have been over the longer term, but not far behind that is UK equities. But we've seen over the 3-year periods, European equities coming through stronger and really catching up some of the underperformance that you'd seen in the European area over the longer term. A good month to have been invested in South Africa, whether it was equities, property or bonds, and we can see the figures there in green. Interestingly, the bond market reacting really positively to the targeting of inflation being brought down to 3%, and that was one of the reasons we saw that market go up quite strongly despite global bond markets weakening during the month. But what I would like to highlight is over the last 5 years you've earned 16.4% if you just were invested in the all-share index. Compare that to global equities, which gave you 13.8% in US dollars, and you got another additional 1.2% for the strengthening of the dollar or the weakening of the rand over that period. So your rand return for offshore equities would have been 15%, while if you'd have been invested in the all-share index, you actually would have outperformed that. Now, we're not saying don't have money offshore, but it just proves the point that markets move in different ways through time, and you don't necessarily just want to be exposed to one market. Let's have a look at how the Core Wealth global strategies have done, and we'll start with our US dollar strategies. Here we have our global models in US dollars, and we can see over the last year done really, really well. Some exceptional outperformance, especially from our defensive and balanced strategies, outperforming their peer groups by between 4.6 and 4.9%. But the long-term track record is really what we're interested in. Over the last 5 years, our balanced strategy has outperformed its peer group by 3% on average per year. And since inception, which is now almost 9 years ago, we've managed to consistently add outperformance against our peer groups, generating some good wealth for clients. If we have a look at the UK models now, much younger models, just over 3 years old, we can see here again some good outperformance of the peer groups, although the absolute returns are lower, and that's just simply because the returns in pounds have been lower than what you'd seen the absolute returns being in dollars. Here's the table of the South African Rand models, and we can see here a lot of green, and over the last year some really nice outperformance of our peer groups. Then interestingly, if we have a look at the 5-year figures, we take our more growth orientated or more aggressive long-term strategies like core wealth balanced, retirement growth and flexible. All of them around 15% return per annum over the last 5 years, which means that if you'd have had 100 Rand invested 5 years ago, it would have more than doubled. It would be over 200 Rand by now. And that's particularly pleasing to see, especially when between 2.6 and 3.1% of that annual performance is due to outperformance. So we've managed to find some good managers who've added outperformance. Did you know that one of the primary responsibilities of the Reserve Bank is to maintain a low level of inflation? And what we've seen in the last month is a change in that policy from previously having targeted inflation within a band to reducing it now, that it intends in future to now focus on a 3% level into the long term. You can see on this graph here that it just shows the blue lines just show you inflation historically and how that has moved down. The red line just shows the average, the long-term average. In 2017, the Reserve Bank moved from a previous target of 3 to 6%, which started in 2000, down to the midpoint of that range being 4.5% from 2017. Now, recently at the last MPC meeting or Monetary Policy Committee meeting, they announced their intention is to actually move that target from 4.5 down to actual 3%. And this will be better for South Africans in the long run, because it means that the prices of our goods, our cost of living, will grow at a slower rate than it has in the past. One of the reasons the Reserve Bank can do this at this point in time is because we've seen inflation being persistently low over the last 9 months at below 3%. We've also seen that we are actually importing deflation from China, and we've seen the Chinese inflation rate coming down both on produced goods or producer inflation as well as their final inflation, and this is because their economy has been slowing a little bit. There's also been concerns around tariffs. They've had challenges in their property market, so a number of things that have pushed them to drop their prices a little bit more, and this has been a positive for us. We've also seen the oil price come down over the last while, and now being between $60 and $70 a barrel. Just like a household has a cost of living, if inflation is high, what we're going to spend on our household next year will be higher than if inflation were low. The South African government also has a cost of living or budget that it needs to manage, and if its costs are going up by a high inflation rate, it has to borrow more to be able to fund that. And what this graph, particularly the one on the right showing the debt servicing costs, it just shows 3 different scenarios that if we can get inflation down to 3% or lower and adjust our borrowing strategy, the costs that the South African government spends on servicing debt is much, much lower. And that means they've got more money to spend on things like education or security, things that the country really needs. These 2 graphs just show you the impact of having different inflation targets through time. The graph on the left just shows you the previous forecast of getting to 4.5% of inflation, the old targets, that's in blue, and then the new target being getting closer to 3% being the one in orange. Now, it does take time for this way of thinking around increasing prices to feed through, and we can see that it's only expected to really get into place around 2027. But the graph on the right shows the impact on growth if we are able to reduce inflation through time. And you can see, although in the short term we wouldn't necessarily have as much growth because there is a price to pay, but over the longer term we can see that that growth in 2027 starts picking up and outperforming the blue lines. And growth is what we need in South Africa. We needed to create jobs, we needed to create wealth, and that then gets the economy moving and people out of unemployment and into a more prosperous life. There is a high correlation between the level of investment that you have in a country and the level of inflation. It's more attractive for foreigners to invest into a country if inflation is lower, because they know the risk of their investment being reduced through currency depreciation is lower. And this graph just shows that. The dotted blue line just shows you that through time, if you have lower levels of inflation, you get higher levels of investment. And we can see here China being probably the supreme example, over 40% investment into their economy, but inflation there well below 5%. South Africa, we've seen inflation come down over this period, but we haven't seen levels of investment picking up as much yet. And this is why some of these negotiations around trade are very important. South Africa needs an environment where foreigners feel comfortable to come and invest into South Africa. And this is something we need to get the growth and to get the jobs we need in South Africa. Thanks for watching this. As you've seen over the last 5 years, we've generated some really good returns, both in absolute terms from strong markets, but also relative to our competitors, generating some really good outperformance. If this is something you or perhaps friends or family are interested or looking for places to invest, we'd love to chat to you. So please give your financial advisor a call. If you have any other questions or future topics you'd like us to discuss, please leave them in the comments below.